Hello, good morning, class. The purpose why I'm going to discuss by now and forward this to the YouTube is because of the scheduled orientation. Now, we cannot hold classes for 2 days. The fact that the time given for the orientation is actually affecting our schedule. So for 7 to 8:30 class for accounting 3122, I could have started a class this morning, but only one student was around. So I would rather have this group accounting 3122 students also open the YouTube and listen to my lecture. Now, actually, accounting 3122 for management accounting students, that's a 3-unit course that will be offered only this first term. So, it's only accounting for business combinations. However, for accounting 3123, it's good for 6-unit course. So that's why we will be covering the topics for the first term, similar to the topic of the accounting 3122 class, which is titled accounting for business combination. However, accounting 3123 students, considering that the course is 6 units, second sem, we will still continue this subject and discuss special transactions, which is no longer applicable to the management accounting students. The fact that their course only good for 3 units. Okay, now I'd like to begin with the syllabus. Actually, we have posted the syllabus for Accounting 3122 in the Canvas, and as well as Accounting 3123 for the 6-unit course. So you can just refer to the Canvas for this. However, considering that the first part of the Accounting 3123 syllabus is still the same as the whole syllabus of the Accounting 3122 students, so this time I will begin by discussing the course syllabus for business combination, and afterwards continue with special transactions. Of course, we have to begin with the vision of the university, that's for exemplary Christian education for life and responsive to the needs of the total person and the world. Now, everybody should be very particular about this because this will involve all your subjects. So you will carry that even after you graduate, being an alumna or alumnus already of Central Philippine University. And the mission is to carry out a program of spiritual, intellectual, moral, scientific, technological, and cultural training and allied studies under influences which strengthen Christian faith, build up character, and promote scholarship, research, and community service. Now, for the institutional outcomes, we have now in 3 to 5 years after graduation, graduates of Central Philippine University shall practice professionalism with integrity and demonstrate Christ-like character, demonstrate patriotism and be law-abiding citizens, use responsibly God-given talents, skills, and resources to promote well-being and productivity of communities and society. demonstrate technological competence in the practice of profession, and demonstrate continuous effort to grow professionally. Now, you will notice that these institutional outcomes, you will meet this in all your subjects. So remember, in 3 to 5 years after graduation. So meaning by that time, you're already professionals and are alumni of CPU. For the program educational objectives and the relationship to CPU's institutional outcomes. So we have now we have the institutional outcomes 1 to 5. So within 5 years after graduation, alumni of the accountancy department should be able to demonstrate competence, professionalism, and integrity in the practice of the accountancy profession and in business related activities. Now, you will notice that all of this relate to the institutional outcomes. Generate and communicate economic information in an efficient and effective manner using English, Filipino, or any appropriate language for multicultural or multi-sectoral stakeholders. Demonstrate managerial or entrepreneurial skills in the practice of profession or allied activities. Pursue continuing professional development or scholarly activities. Participates in a professional, civic, or local organization which strengthens the profession, promotes social responsibility or nationalism. So take note of these very, very important outcomes which you are going to practice uh, not only now but after graduation. Students are strongly encouraged to take advantage of the consultation hours. Now, actually, the syllabus that we are using now is the latest revised edition that will be applicable beginning this semester. Okay, so we have now for the program outcomes. For the program outcomes of the BS Accountancy. So we have the BS Accountancy graduates should be able to resolve business issues and problems. So again, we are referring to here the program educational objectives, and now we have the objectives of the Department of Accountancy for the BS Accountancy program. uh, in the areas of financial accounting and reporting, cost accounting and management accounting and control, taxation, or accounting information systems. Conduct accountancy research through independent studies of relevant literature and appropriate use of accounting theory and methodologies. Employ technology as a business tool in capturing financial and non-financial information, generating reports, and making decisions. Apply knowledge and skills that will successfully respond to various types of assessments, including professional licensure and certifications. Confidently maintain a commitment to good corporate citizenship, social responsibility, and ethical practice in performing functions as an accountant. Now we have the program outcomes related to the course and relationships to the program educational objectives. So we have those stated above and how this would be related or connected to our program educational objectives. So, again, take note that almost all of this, except very few, are not connected to each. Okay, so our subject, Accounting 3123, is accounting for business combinations and special transactions. Whereas for Accounting 3122, that's for the management accounting students, that's only accounting for business combination, a 3-unit course. This course deals mainly with consolidation and mergers, parent-subsidiary relationship, and consolidated statements, including foreign subsidiaries. So we have now the other topics deal with accounting for the effects of changes in foreign exchange rates and other similar current issues. Also discussed is accounting for the winding up of a business entity. Now, this objective or the objectives as mentioned would relate to Accounting 3122 as well. And for the first part of Accounting 3123. However, the last part of Accounting 3123, which will be applicable during the second term, we have what we call special transactions dealing with specialized accounting problems likely to be encountered by accountants. It exposes the learners to accounting for transactions and activities that relate to business organizations other than the corporate form. The study of the various topics in this course is based upon fundamental valuation, accounting, and accounting theory as applied to special income and expenses recognition methods and expanded business operations. Included are accounting for joint arrangement, foreign currency transactions, home office, branch and agency transactions, installment sales, consignment sales, insurance contracts, partnership accounting, long-term construction contracts, franchise operations, build operation transfer or BOT, and derivatives. Now we have, before you are allowed to take up this course, the prerequisite is Accounting 2313. And the credit for this course, for the Accounting 3123 is 6 units. However, for Accounting 3122, it's only good for 3 units. So I have mentioned that the syllabus applicable to 3122 is posted in the canvas as well as that of 3123, which is longer. Now we have now the consultation time is 1 to 2:30, Monday to Friday, and of course we have our online consultation. Now anyway, I will be moving the consultation time 12 to 1 instead of 1 to 2:30 since I will already have a class by this time. So 12 to 1 you can just call me through my cell number. Through my cell number, I have to, or you have to just text me through my cell number, and anyway, I hope I can reply immediately. So my new cell number is 0960 856-8190. 0960-856-8190. So, or you have the email ad given. So, take note that the consultation time is 12 to 1, which I have to change because I have a class by 1 to 2:30. Okay, so we have now for the course outcomes and relation to program outcomes. So we now have the okay, course outcome number 1, define, understand, and account for business combination, including consolidation and mergers, parent and subsidiary relationship, prepare consolidation, working papers, elimination entries, separate financial statements, consolidated statement of comprehensive income, retained earnings statement, and statement of financial position. So we have now the course outcome number 1. Then for number 2, account for the effects of changes in foreign exchange rates. Number 3, account for the winding up of the affairs of a business entity. 4, characterize joint arrangements and equity method of accounting. 5, identify the foreign currency of a company and account for it. 6. Distinguish an agency from a branch. Prepare journal entries and financial statements for each. 7. Account for installment sales, consignment sales. 8. Explain each type of insurance contracts. State the essential elements of each. 9. Account for partnership formation, division of profits and losses, admission of a new partner, and liquidation. 10. Determine and account for revenue from construction contracts, from franchise contracts, from build, operate, transfer arrangement. 11. Account for derivatives and hedging transactions. 12. Internalize the CPU core values. Exhibit the value of honesty, independence, and discipline in complying the course requirements. Now, again, I'd like to emphasize that the syllabus I am reading now is for the accounting 3123 students. However, accounting 3122 students, you have your own syllabus which is shorter. You can have it through Canvas. So we have now for course design. For week 1, first we have course outcome number 12, always to be considered. Students will be able to learning objectives 1. Demonstrate commitment to uphold the vision and mission of CPU. So we have the orientation by emphasizing to you, and you have to memorize by heart the vision and mission of the CPU, rules and regulations, basic requirements of the course, and we have the classroom policies. So we have now your learning objective number 1, number 2, ethically comply with the requirements of the course. So we have now the CPU vision, mission, and core values, the grading system found at the last part of the syllabus, and we have the class policies. Then course outcome number 1, these students, now we will be beginning with module number 1, which is already business combination. And we have the definition of business combination. Actually, the source will be Dayag Antonio 2021 and the latest is 2022, the book that we will be using now. Now we have learning objective 1, define business combination, identify its essential elements, describe the acquisition method of accounting for it. Then two, account for business combination accomplished through share exchanges achieved in stages and achieved without transfer of consideration. 3. Discuss the measurement period in relation to business combination. 4. Distinguish what is part of business combination and what is part of the separate transaction. 5. Define and compute goodwill in relation to business combination. 6. Define reverse acquisition and combination of mutual entities. 7. State and understand the elements of control in a parent-subsidiary relationship. Prepare consolidated working papers and statement of financial position at the date of acquisition. Distinguish the three methods to account for investment in subsidiary, joint venture, and associates. Discuss the procedures related to prepare needed to prepare consolidated statement of comprehensive income, retained earnings statement, and statement of financial position in period subsequent to acquisition of a subsidiary. Prepare consolidated working papers and the various statements. 11. Distinguish downstream from upstream sale of inventory in relation to affiliated companies. Prepare elimination entries for intercompany transactions. 12. Prepare consolidated working papers and statements after elimination of intercompany profits in inventories of affiliated companies. 13. Prepare elimination entries for intercompany transactions related to property, plant, and equipment of affiliated companies. Prepare consolidated working papers and financial statements. 15. Compute for consolidated retained earnings and profit and loss attributable to owners of parent and non-controlling interest. Prepare elimination entries for the dividends received from the subsidiary. And we have to prepare consolidated working papers and financial statements. Compute for consolidated retained earnings and profit and loss attributable to owners of parent and non-controlling interest. Internalize CPU core values. Exhibit the values of honesty, independence, and discipline in complying the course requirements. Now, these are your learning objectives, and of course we will have our long exam number 1 between weeks 2 and 3, and our midterm exam will be between weeks 4 and 5. Long exam number 2 will be between week 6 and 7, and midterm 2 will be on week number 9, because second term, then there we are going to have the final exams. Okay, so in this connection, again, I'd like to emphasize that business combination, we have only one syllabus applicable for both Accounting 3122 and Accounting 3123 classes for business combination. That's all applicable for the first term. So we now have the set of learning objectives and the activities that we have to involve and the modules that will be used. So we have now your advanced accounting books. Of course, our author is Dayag Antonio, and we have the sources. So we have now the module applicable. I'd like you to refer to the modules. Here we have the list of topics that we are going to discuss. So at least we will be guided accordingly. Now, this time I'm going to refer to the PowerPoint presentation applicable already to module number 1 in connection with our first set of learning objectives. So, refer now to the PowerPoint presentation. Okay, so here we have the PowerPoint presentation for business combination. Now, this is quite a long set of discussions. Actually, you can find this in chapter 1. And we are now trying to relate this to our course outcomes and to the learning objectives. So once in a while, you refer to your syllabus. So we have to involve the introduction. Accounting for business combination is one of the most significant and interesting topics of accounting theory and practice. It's a multifaceted and divisive. A business combinations involve financial transactions of immeasurable magnitudes, business empires, triumphant stories, and individual fortunes, managerial genius, and management debacles. By their nature, they affect the destiny of entire companies. Each is exceptional and must be evaluated in terms of its economic substance, regardless of its legal form. Why do business entities enter into a business combination? Although a number of reasons have been cited, the overriding reason is probably growth. Growth is a major objective of many business organizations. A company may grow slowly, may gradually expand its product lines, facilities, or services, or may skyrocket almost overnight. Okay, so we have now your introductory part of business combination, and here, as mentioned, this chapter presents reasons for the popularity of business combination, the methods and techniques in dealing with them. So we have now the nature of business combination. A business combination may be friendly or unfriendly, hostile takeovers. In a friendly combination, the board of directors of the potential combining companies negotiates mutually agreeable terms of a proposed combination. An unfriendly hostile combination results when the board of directors of a company targeted for acquisition resist the combination. So that means unfriendly. Because they are relatively quick and easily executed, often in about a month, tender offers are the preferred means of acquiring public companies. Okay, so we have now the acquisition of preferred means of acquiring public companies. So tender offers are the preferred means of acquiring public companies. Now, resistance often involves various moves by the target company, generally with colorful terms. Whether such defenses are ultimately beneficial to shareholders or not remains a controversial issue. In unfriendly hostile takeover, the following are defensive tactics or moves to resist the proposed business combination with the following colorful designations: poison pill, green mill, white knight or white squire, Pacman defense. Now, Pacman nga nagboxing kagapon. Okay. So, it's actually a term. But it really refers to our very own Pacman. Selling the crown jewels or scorched earth. Shark repellent. Leverage buyouts. The mud sledging defense. The defensive acquisition tactic. Now, what are the reasons for business combinations? We have the following. There are several ways of business expansion. It may either be through acquisition or construction of new amenities or through business combination. Following are the reasons why business combination may be preferred as compared to other means. Cost advantage, no? Why is it uh, that you are going to have this business combination? Cost advantage, lower risk, avoidance of takeovers, acquisition of intangible assets, other reasons. So we have now your reasons to consider. Several ways of business expansion, which may either be through acquisition or construction of new amenities or through business combination. We have now the reasons why business combination may be preferred as compared to other means. Okay, so we have now your types of business combinations. Business combinations may be classified under three schemes. One based on the structure of the combination, one based on the method used to accomplish the combination, and one based on the accounting method used. Structure of business combination. In general terms, business combinations unite previously separate business entities. Because of this reason, combinations are classified by structure into four types: horizontal, vertical, conglomerate, and circular. So remember these four types: horizontal integration, vertical, conglomerate, and circular combination. So we have now these possible structures. The structure of business combination may be determined by a variety of factors, including legal and tax strategies. Other factors might include market considerations and regulatory considerations. Include one business becomes a subsidiary of another. Two entities are legally merged into one entity. one entity transfers its net assets to another entity. An entity owners transfer their equity interest to the owners of another entity. Two or more entities transfer their net assets, or the owners transfer their equity interest to a newly formed entity, sometimes termed as roll-out or put together transaction. And uh, the structure business combination again may be determined by a variety of factors, including legal and tax strategies. So we have already referred to one business becomes subsidiary of another. Two entities are legally merged into one. One entity transfers its net assets to another entity. An entity owners transfer their equity interest to the owners of another entity. Two or more entities transfer their net assets, or the owners transfer their equity interest to a newly formed entity, sometimes termed as roll-up or put-together transaction. And a group of former owners of one entity obtains control of a combined entity. So we have this in possible structures. Now the methods types of combinations, we have the legal forms of effecting business combinations. There are four types of combination which can be identified from legal and organizational perspectives. From legal perspective, accounting, and organizational perspective, the specific procedures to be used in accounting for a business combination is affected through acquisition of net assets. So net assets meaning assets less liabilities. Acquisition of common stock, stock acquisition, asset acquisition. So we have now your acquisition of net assets. The books of the acquiree company are closed out, and its assets and liabilities are transferred to the books of the acquirer for the acquiring surviving company. Following are the features of an asset and liabilities acquisition. The acquirer acquires from another enterprise all or most of the net assets of the other enterprise for cash or other property, debt instruments, and equity instruments, common or preferred stock, or a combination thereof. The acquirer must acquire 100% of the net assets of the acquired company. This involves only when the acquiring company survives. Acquisition of net assets are classified into statutory merger, consolidation. In this chapter, we focus on the acquisition of net assets of the acquired company. So we focus on the acquisition of net assets of the acquired company. Acquisition of common stock or stock acquisition. The books of the acquirer, acquiring company, and the acquiree, acquired company. The acquirer, acquiring company, debits an account investment in subsidiary. A business combination effected through stock acquisition does not necessarily have to involve the acquisition of all of a company's outstanding voting common shares. Following are the features of stock acquisition. The acquirer acquires voting common stock from another enterprise for cash or other property, debt instruments, and equity instruments, common or preferred stock, or combination thereof. The acquirer must obtain control by purchasing 50% or more of the voting common stock or possibly less when other factors are present that lead to the acquirer gaining control. The acquired company need not be dissolved. That is, the acquired company does not have to go out of existence. Both the acquirer, acquiring company, and the acquiree, acquired company remain as separate legal entities. Now, further discussions and illustrations for the topic stock acquisition will be discussed in the next chapters. Okay, so we have now the further discussions for the next set of chapters. Okay, now we have the asset acquisition. It reflects the acquisition by one firm of assets and possibly liabilities of another firm but not its shares. The selling firm may continue to survive as a legal entity or it may liquidate entirely. The acquirer typically targets key assets for acquisition or buys the acquiree's assets but does not assume its liabilities. So we have now often the assets acquired are in the form of a division of product line. The acquirer may not buy the entire entity. It should be noted that asset acquisition is not within the scope of business combination under PFRS 3. So asset acquisition not within the scope of business combination under PFRS 3. Okay, so we have now your two independent issues related to the consummation of a combination. What's required? Net assets, stock or assets, and what's given up. So what is acquired? What's acquired? Net assets, stock or assets. What's given up? The consideration for the combination. So you have to consider two things, what's acquired and what is given up. Acquisition of net assets, assets less liabilities. The terms merger and consolidation are often used synonymously for acquisitions. However, legally and in accounting there is a difference. The distinction between these categories is largely technicality, and the terms mergers, consolidation, and acquisitions are popularly used interchangeably. There are two independent issues, no? Again, I'd like to emphasize that the two independent issues would relate to what's given up and what is acquired. Okay, statutory merger. For statutory merger, we have now statutory merger entails the acquirer company survives, whereas the acquiree company sa table. The acquired company or company ceases to exist as separate legal entity, although it may be continued as separate division of the acquiring company. Thus, if A company acquires B company in a statutory merger, the combination is often expressed as. Ano yung mga kaibigan na kaibigan kaon ka na. Okay, so we have now your X company plus Y company equals X company or Y company. That's in a merger. In other words, of the two companies that combine, only one company will remain. X company plus Y company. So whatever will remain, it's either X company or Y company. Statutory consolidation results when a new corporation is formed to acquire two or more other corporations. The acquired corporations then cease to exist, dissolved as separate legal entities. For example, if C company is formed to consolidate A company and B company, the combination is generally expressed as. So we have now X company plus Y company. What will come out is Z company. In other words, you can no longer find the names of the combining companies. Unlike in merger, that if you have X and Y, what will remain is either X or Y. While in a consolidation, if you have X and Y, what will come out is a new name. Okay, so it's either C company or A company. Future references in this chapter. The term merger in the technical sense of a business combination in which all but one of the combining companies go out of existence. Similarly, the term consolidation will be used in its technical sense to refer to a business combination in which all the combining companies are dissolved and a new corporation is formed to take over their net assets. Consolidation is also used in accounting, which refers to the accounting process or procedures of combining parent and subsidiary financial statements, such as in the expressions principles of consolidation, consolidation procedures, and consolidated financial statements. In succeeding chapters, the meaning of the term consolidation refers to stock acquisition as a matter of procedure to prepare consolidated financial statements. The business combination defined as stock acquisition is expressed as financial statements of X company and that of Y company. We have now the consolidated financial statements of X company and Y company. So we have now your combined statements. Accounting concept of business combination. The accounting standard relevant for accounting for business combination is PFRS 3, Business Combinations, issued by the International Accounting Standards Board. Definition: PFRS 3 defines business combination as a transaction or other event in which an acquirer obtains control of one or more businesses. Transactions, sometimes referred to as through mergers or mergers of equals, also are business combinations. Okay? A first key aspect in this definition is control. This means that there must be a triggering economic event or transaction and not, for example, merely a decision to start preparing combined or consolidated financial statements for an existing group. Control can usually be obtained either by buying the assets or buying enough shares. Okay, so we have now control. Uh, Economic events that might result in an entity obtaining control include transferring cash or other assets, including net assets that constitute a business, incurring liabilities, issuing equity instruments, combination of the above, and a transaction not involving consideration, such as combination by contract alone, such as a dual-listed structure. The meaning of control will be discussed in Chapter 2, and the accounting procedures are thoroughly discussed in succeeding chapters. Okay, so economic events, no? That should be considered. The second key aspect of the definition is that the acquirer obtains control of a business. So we have now uh, the meaning of business, control. The meaning of control, and second is we have business. Okay, so we have now your identifying a business. PFRS 3 defines the term business as an integrated set of activities and assets that's capable of being conducted and managed for the purpose of providing goods or services to customers, generating investment income such as dividends or interest, or generating other income from ordinary activities. The definition of business was narrowed by focusing on providing goods and services to customers, removing the emphasis from providing a return to shareholders, removing the reference to lower cost or other economic benefits. The business combination must involve the acquisition of a business, which generally has three elements. We have now the inputs. We have now the three elements of a business combination: inputs, process, and output. So we have the inputs, the process, and the output. The purpose of dividing a business is to distinguish between the acquisition of a group of assets, such as a number of chairs, bookshelves, and filing cabinets, and the acquisition of an entity that's capable of producing some form of output. Accounting for a group of assets is based on standards such as PE 16, property, plant, and equipment, rather than PFRS 3. Scope of business combination. The following transactions are within the scope of PFRS 3. Combinations involving mutual entities achieved by contract alone, dual listing. On the other hand, the following transactions are not within the scope of PFRS 3, where the business combination results in the formation of all types of joint arrangements, joint ventures, and joint operations, and the scope exception only applies to the financial statements of the joint venture or the joint operation itself, and not the accounting for the interest in a joint arrangement in the financial statements of a party to the joint arrangement. Well, the business combination involves entities of a business under common control, and where the acquisition of an asset or a group of assets does not constitute a business. Now, on the other hand, the following transactions are not within the scope of PFRS 3, where the business combination results in the formation of all types of joint arrangements, joint ventures, and joint operations, and the scope exception only applies to the financial statements of the joint venture or the joint operation itself, and not the accounting for the interest in a joint arrangement in the financial statements of a party to the joint arrangement. Where the business combination involves entities of a business under common control, where the acquisition of an asset or a group of assets does not constitute a business. The term used to indicate this transaction is asset acquisition. In such circumstances, the acquirer okay, tanawa, hindi na ni slides. Identifies and recognizes the individual. Okay, okay. So let me see. We have the on the other hand, the following are not within the scope of PFRS 3, where the business combination results in the formation of all types of joint arrangements, joint ventures, and joint operations, and the scope exception only applies to the financial statements of the joint venture or the joint operation itself, and not the accounting for the interest in a joint arrangement in the financial statements of a party to the joint arrangement, where the business combination involves entities or businesses under common control, where the acquisition of an asset or a group of assets does not constitute a business. The term used to indicate this transaction is asset acquisition. In such circumstances, the acquirer identifies and recognizes the individual identifiable assets acquired, including those assets that meet the definition of and recognition criteria for intangible assets in PAS 38, intangible assets and liabilities assumed, and allocates the cost of the group of assets and liabilities to the individual assets and liabilities on the basis of the relative fair value at the date of purchase. Such transaction or event does not give rise to goodwill. The acquisition method is applied on the acquisition date, which is the date the acquirer obtains control of the acquiree. The acquisition method approaches a business combination from the perspective of the acquirer, not the acquiree. The entity that obtains control of the other entity or entities in the business combination. Under the acquisition method, all assets and liabilities are identified and reported at their fair values. Accounting procedures for business combination. The required method of accounting for a business combination under paragraph 4 of PFRS 3 is the acquisition method. Under the acquisition method, the general approach to accounting a business combination is a 5-step process. Identify the acquirer, determine the acquisition date, calculate the fair value of the purchase consideration transferred, such as the cost of purchase, recognize and measure the identifiable assets and liabilities of the business, and recognize and measure either goodwill or a gain from a bargain purchase if either exists in the transaction. So you have to recognize, okay, recognize and measure either goodwill. If not goodwill, then it's a gain from bargain purchase. If an acquirer gains control by purchasing less than 100% of the acquired entity, then the fourth step includes measuring and recognizing the non-controlling interest. Discussion of NCI will be in Chapter 2. Identifying the acquirer. PFRS 3, paragraph 7 states that the acquirer is the entity that obtains control of the acquiree. Paragraph 6 requires that in each business combination, one of the combining entities should be identified as the acquirer. So, one of the combining entities. The concept of control under PFRS 3 will be discussed methodically in Chapter 2. PFRS 3, however, recognizes that it may be difficult to identify which entity has control over other combining entities. In the event that the overriding principle of control in PFRS 3 does not conclusively determine the identity of the acquirer, PFRS 3 provides additional guidance. Determining the acquisition date. PFRS 3 defines the acquisition date as the date on which the acquirer obtains control of the acquiree. A business combination involves the joining together of assets under the control of a specific entity. Therefore, the business combination occurs at the date of the assets or net assets are under the control of the acquirer. This date is the acquisition date. Other dates that are important during the process of a business combination may be the date the contract is signed, the date the consideration is paid, date nominated in the contract, the date on which assets acquired are delivered to the acquirer, and the date on which an offer becomes unconditional. The definition of acquisition date then relates to the point in time when the net assets of the acquiree become the net assets of the acquirer. In essence, the date on which the acquirer can recognize the net assets acquired in its own records. There are four main areas where the selection of the date affects the accounting for business combination. 1. Identifiable assets acquired and liabilities assumed by the acquirer, the consideration paid by the acquirer. The acquirer may acquire only some of the shares of the acquiree. The acquirer may have previously held an equity interest in the acquiree prior to obtaining control of the acquiree. The effect of determining the acquisition date is that the financial position of the combined entity on acquisition date should report the assets and liabilities of the acquiree on that date, and any profits reports as a result of the acquiree's operation within the business combination should reflect profits earned after the acquisition date. Okay, so these are now the four main areas where the selection of the date affects the accounting for business combination. Again, the identifiable assets, the consideration paid, the acquirer may acquire only some of the shares, and the acquirer may have previously held an equity interest in the acquiree prior to obtaining control. Calculating the fair value of the consideration transferred. Accounting records of the acquirer. Accounting to PFRS 3, according to PFRS 3, paragraph 37, the consideration transferred is measured at fair value at acquisition date, is calculated as the sum of the acquisition date fair values of the assets transferred by the acquirer, the liabilities incurred by the acquirer to former owners of the acquiree, and the equity interest issued by the acquirer. Now, in a specific exchange, the consideration transferred to the acquirer should include just one form of consideration, such as cash, but could equally well consist of a number of forms. Okay, let's continue. We are still in chapter 1. You know, chapter 1 is a very long chapter, so it has a very long PowerPoint presentation. In a specific exchange, the consideration transferred to the acquirer should include just one form of consideration, such as cash, but could equally well consist of a number of forms, such as cash, other assets, business, or as a subsidiary of the acquirer, contingent consideration, equity instruments, common or preferred, and debt instruments, options, warrants, and member interests of mutual entities. The consideration transferred includes the following items: cash or other monetary assets for deferred payment, the fair value to the acquirer; non-monetary assets, equity instruments, liabilities undertaken, contingent consideration, share-based payment awards. For acquisition-related costs, in addition to the consideration transferred by the acquirer to the acquiree, a further item to be considered in determining the cost of the business combination is the acquisition-related cost. Acquisition-related costs are excluded from the measurement of the consideration paid because such costs are not part of the fair value of the acquiree and are not assets. They are as follows: costs directly attributable to the combination, which includes costs such as legal fees, finders and brokerage fee, advisory, accounting, valuation, and other professional or consulting fees. Indirect ongoing costs, general costs, including the cost to maintain an internal acquisition department, mergers and acquisitions department, as well as general and administrative costs such as managerial, including the cost of maintaining an internal acquisitions department, management salaries, depreciation, rent, and costs incurred to duplicate facilities, overhead that are allocated to the merger but would have existed in its absence, and other costs of which cannot be directly attributed to the particular acquisition. The PFRS 3 accounting for these outlays is a result of the decision to record the identifiable assets acquired and liabilities assumed at fair value. The acquisition-related costs associated with a business combination are accounted for as expenses. So take note of this. The acquisition-related costs associated with the business combination are accounted for as expenses in the periods in which they are incurred and the services are received. The key reasons given for this approach are: acquisition-related costs are not part of the fair value exchange between the buyer and seller. They are separate transactions for which the buyer pays the fair value for the services received. These amounts do not generally represent assets of the acquirer at acquisition date because the benefits obtained are consumed as the services are received. Cost of issuing equity instrument share issuance cost is also excluded from the consideration and accounted for separately. In issuing equity instruments such as shares as part of the consideration paid, transaction costs such as documentary stamp duties on new shares, professional advisor fees, underwriting costs, and brokerage fees may be incurred. Further, if the share premium or additional paid-in capital from the related issuance is not enough to absorb such costs, the Philippine Interpretations Committee or the PIC concluded that the excess shall be debited to share issuance costs, which will be treated as a contra shareholders' equity account as a deduction in the following order of priority. 1. Share premium from previous share issuance. So again, we are now trying to consider if the share premium or additional paid-in capital from the related issuance is not enough to absorb such costs. The Philippine Interpretations Committee concluded that the excess shall be debited to share issuance costs, which will be treated as contra shareholders' equity account as a deduction in the following order of priority. 1. Share premium from previous share issuance or retained earnings with appropriate disclosure. On a personal note, the word or indicated on the Philippine Interpretations Committee Q&A as published should be removed since it's quite misleading because the statement or the priority was already in use. Companies often incur additional acquisition-related restructuring costs, including shutting down departments, reassigning or eliminating jobs, and changing suppliers or production practices in connection with business combinations. Unless presented by acquisition date liabilities, these costs are expensed as incurred and do not affect acquisition cost. Further, the share premium or additional paid-in capital from the related issuance is not enough to absorb such costs. Now, I am trying to repeat this because this is a very important rule. Debited share issuance cost, which will be treated as contra shareholders' equity account as a deduction in the following order of priority: share premium from previous share issuance or retained earnings with appropriate disclosure. On a personal note, the word or indicated on the Philippine Interpretations Committee Q&A as published should be removed. Companies often incur additional acquisition-related restructuring costs, including shutting down departments, reassigning or eliminating jobs, and changing suppliers or production practices in connection with business combination. Unless represented by acquisition date liabilities, these costs are expensed as incurred and do not affect acquisition costs. In the past, firms have sought to capitalize these acquisition-related restructuring costs, effectively reporting them as goodwill and not as expenses. Okay, so we have now the PIC committee also considered listing fee for initial public offering of shares as an outright expense. Cost of issuing debt instruments. Similarly, with equity instruments, the cost of arranging and issuing debt instruments or financial liabilities in accordance with PFRS 9 are an integral part of the liability issue transaction. They are deemed shield adjustments to the cost of borrowing. These costs are included in the initial measurement of the liability as bond issue cost and amortized over the life of the debt. Summary of acquisition-related costs. Acquisition-related costs directly attributable. So we have now the examples. So treatment expenses. Indirect acquisition costs. So you have now your general and administrative costs such as managerial, including the cost of maintaining an internal acquisitions department, management salaries, depreciation, rent, and costs incurred to duplicate facilities, overhead that are allocated to the merger but would have existed in its absence, and other costs which cannot be directly attributed to the particular acquisition, uh, so treated as expenses. And patyanamik, ilo non, oo non, ilo, ilo, oo non, oo. Okay, let's continue. I'm sorry for the interruption, but because of very important call. So, okay, so in here we are going to determine the treatment of each acquisition-related cost. So, these are very, very important guidelines that you have to remember in connection with the treatment of your acquisition-related cost. So some of these, number 1 and 2, will be treated as expenses. In number 3, cost of issuing securities, issue and register stocks refer to transaction costs such as stamp duties, new shares, professional advisors fee, underwriting costs, and brokerage fees may be incurred. Debit to share premium or additional paid-in capital account. Then costs of arranging, registering, and issuing debt securities or financial liabilities, professional advisors fees, underwriting costs, and brokerage fees may be incurred. Now, they are treated as bond issue cost. Okay. So, we have now your treatment. No, the principles in assessing what's part of the business combination. PFRS 3 requires that an acquirer shall assess whether any portion of the transaction price, payments, or other arrangements, and any excess acquired or liabilities assumed or incurred are not part of a component of the exchange for the acquiree. Only the consideration transferred and the assets acquired or liabilities assumed or incurred that are part of the exchange for the acquiree shall be included in the business combination accounting. Any portion of the transaction price or any assets acquired or liabilities assumed or incurred that are not parts or components of the exchange for the acquiree shall be accounted for separately from the business combination. Recognition and measurement of assets acquired and liabilities assumed, accounting records of the acquirer. PFRS 3 sets out basic principles for the recognition and measurement of identifiable assets acquired, liabilities assumed, and non-controlling interest. Having established those principles, the PFRS 3 provides detailed application for specific assets and liabilities and a number of limited exceptions to the general principles. Under the acquisition method, the acquirer is required to recognize identifiable assets and liabilities separately from goodwill and measure such assets and liabilities at their fair values on the date of acquisition. Recognition principle for assets and liabilities. A key word is identifiable. The acquirer may be able to identify many more assets and liabilities than those shown in the acquiree's balance sheet. PFRS 3 paragraph 10 requires that as of the date of the acquisition, the acquirer should recognize separately from goodwill the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquirer. Paragraph 83 of the framework for the preparation and presentation of financial statements specifies two recognition criteria for assets and liabilities, stating that the recognition occurs if it's probable that any future economic benefit will flow to or from the entity and the item has a cost or value that can be reliably measured. Condition for recognition principle in paragraph 11 and 12 of PFRS 3. There are two conditions that have to be met prior to the recognition of assets and liabilities acquired in the business combination. At the acquisition date, the assets and liabilities recognized by the acquirer must meet the definition of assets and liabilities in the framework. Any expected future cost cannot be included in the calculation of assets and liabilities acquired and liabilities assumed. The following are outcomes as a result of applying this recognition condition: post-acquisition reorganization, unrecognized assets and liabilities, and we have now the exception to the recognition principle. Uh, Only one area is affected by this condition, is the accounting for contingent liabilities. PS 37 provisions, contingent liabilities, and contingent assets. The term acquired or assumed must be part of the business acquired rather than the result of a separate transaction. As noted in paragraph 13 of PFRS 3, a possible result of applying the principle of PFRS 3 is that there may be assets and liabilities recognized as a result of the business combination that were not recognized by the acquiree. One example of these internally generated intangibles that were not recognized by the acquiree on the application of PES 38 intangible assets. For example, internally generated brands would not be recognized by an acquiree but would be recognized by the acquirer. The acquirer would measure this at fair value. Measurement principle for assets and liabilities. Identifiable assets acquired in the liabilities assumed are measured at their fair values on acquisition date fair values. PFRS 13 defines fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date, such as an exit price. Measurement principle for assets and liabilities. Again, the definition of fair value emphasizes that fair value is a market-based measurement, not an entity-specific measurement. Fair value is basically a market-based measure in a transaction between unrelated parties. However, the process of determining fair value necessarily involves judgment and estimation. The acquiring entity is not actually trading the items in the marketplace for cash but is trying to estimate what the exchange price would be if it did so. Hence, the determination of fair value involves estimation. To assist in the determination of fair value, the standard setters have developed a fair value hierarchy. The hierarchy categorizes the inputs used in valuation techniques into three levels. Fair value, no, into three levels. The hierarchy gives the highest priority to unadjusted quoted prices in active markets for identical assets or liabilities, and the lowest priority to unobservable inputs. Okay, so measurement under the fair value hierarchy is as follows. It should be noted that inputs are being prioritized. Level 1 inputs are fully observable and are unadjusted quoted prices in an active market for identical assets and liabilities. So for this, we have now level 2 inputs are directly or indirectly observable inputs, and level 3 inputs, observable inputs for the asset or liability not based on observable inputs. Okay, so I am going to assign to you the theory questions in chapter 1. So just read through the last part of the discussions. Actually, we have almost 78 slides. Okay, and there are still remaining slides which I have not read. And so please finish reading them in your canvas and try to answer chapter 1 multiple choice questions and true or false questions. So true or false questions and multiple choice questions of chapter 1. I'll repeat, answer multiple choice questions and true or false questions of chapter 1. By tomorrow, I will continue discussing chapter 1. So I hope you understand why this YouTube, our subject matter is very, very long, with very long coverage, and I hope this will help us save some time, no, in terms of the topics. So see you on Thursday. Tomorrow, please open the YouTube again. Okay? So good morning and God bless us all. Init. Daw kwa na. 1 hour